Good day, students. I've returned your individual feedback for each of the syndicate assignment groups, but now I'd like to quickly go over just the questions and sort of how you were meant to tackle the questions. I'll be doing two parts to the syndicate assignment feedback. The first part will be the financial accounting, and then we'll do the management accounting in the second session. All right, so in terms of the financial accounting section, firstly, what you should have picked up is that they have provided you with liquidity ratios for the food and manufacturing sector. So given that you've got the food and manufacturing sector ratios, you are able to then also compare with the industry should they ask for any liquidity and solvency ratios to be performed. Okay, so the first question we were meant to do is just prepare and analyze the common size financial statements of only AVI Limited using the information provided. Okay, most students were able to get this correct. So what I've done here on the right on the Excel spreadsheet is put together all of AVI's statement of comprehensive income for 2018, 19, and 20, as these 3 years were provided. I've also then provided the statement of financial position and the statement total equity and liabilities coming through here. Okay, this is your entire statement that I've copied through from your annual report. What you're going to do then when you're looking at your common size financial statements is you're going to prepare a common size income statement for all 3 years, and what you're going to do is then multiply each one by the sales percentage. So here I've multiplied it by the sales, and each time I'm going to keep dividing it by the sales. Okay, if you noticed carefully what it says here, a lot of students also miss this. It says prepare and then analyze. Okay, so we were supposed to have prepared these, but we were also meant to comment and do a bit of an analysis. One thing you should notice when we ask you to analyze the common size, you don't have to go and analyze all the lines that especially are not material. The major lines we needed to analyze here is the gross profit. So we've had a continuous decline in your gross profit margin. It initially was at 44% in 2018 and it's now declining to 40%. And then you could also comment on this line, selling and admin expenses. The selling expenses have reduced over time, which is a good indication. So we're having a reduction in your selling and admin expenses. However, your gross profit is declining. So those are the two line items you were meant to analyze. If we look at the net profit margin, your net profit margin will just be your net profit divided by your sales figure. This has increased in 2020, which is a good sign. Excuse me. And because it's increased, this is actually indicative of the fact that also your selling and admin expenses have come down over time. All right. So if you look at the statement of financial position, your statement of financial position, each line item will be divided by your total assets figure. Okay, so we take all your line items and divide it by your total assets figure. And the big items you'll notice here that you need to analyze is your plant and equipment. Your plant and equipment as a percentage of total assets has remained quite stable. Whereas if you notice here, we've gone from 22 to 26% is your inventories. So we have had a pickup in inventories. We will have to comment on the fact that the inventories have picked up over the last 3 years. But the question is whether the reason why they've picked up is because they've been investing more in inventories or whether the inventories are slow moving and are no longer selling. Okay, so we can analyze that. Okay, some people chose to also comment on the intangibles and goodwill. Okay, they've remained stable for the last 2 years, but there was a slight decrease in your intangibles and goodwill. And then all the other items are quite small besides your liabilities. So if we look here, your lease liabilities as a percentage of total assets from 17% to 25% to 20%. Your lease liabilities as a percentage of, you can combine it with these liabilities here. So here we were sitting at 17, here 28, and then it's gone to 22. Quite a volatile lease liability. So here I'm looking at the current portion and here the non-current portion. So your lease liabilities are still increasing. Okay, slightly. They increased in 2019 and dropped in 2020. But if you look at your trade and other payables, these have slightly come down over time. All right, so you were meant to prepare these common size percentages, but at the same time, you were meant to comment briefly on the bigger major items that are either increasing or decreasing over time. The next question then asks you to compute and analyze the profitability ratios for 2019 and 2020. Okay, so what I've done here is I've computed all the profitability ratios for 2019 and 2020 for AVI Limited. They didn't ask you for 2018, but I've also prepared it for 2018 just to see the trend. Okay, so marks were not rewarded here for the 2018. You should have compiled the 2019 and 2020. Part 2 also asks you to compare the profitability for 2019 with Tiger Brands. So here you are meant to also compute then your Tiger Brands profitability ratios. And then what we should be able to compare is we can then compare this 2019 with AVI Limited's 2019. Okay, so what I've done here is I've calculated the net profit margins for the two. I've calculated the gross profit margins for the two. You'll notice here, when we talk to AVI Limited has a much bigger gross profit margin in comparison to Tiger Brands. And the net profit margin, though, has come down. So if we were to look at what actually makes up your net profit before your items, your biggest cost in terms of your net profit margin is your selling and admin expenses. Okay, so the question is whether AVI Limited is spending too much on their selling and general expenses because they're giving away some of their profit, that gross profit margin, and it reduces when it gets to the net profit margin in comparison to a Tiger Brands. Okay, but then when we look at the different net profit margins for the different segments, if one computed these were not rewarded marks, but if you did compute, I did give you extra marks. The net profit margin for the food and beverages components, here you're getting 19.27, whereas for Tiger Brands you're only getting 7%. Okay, personal care, you're getting 21% versus 20. These are quite similar. Okay, then you needed to compare your return on assets, your return on capital, and your return on equity. Okay, what we did then ask is what is the main contributor of 2019 earnings in AVI? You needed to compute your DuPont. So here your DuPont needs to come back to your return of equity. So I've disaggregated the 3 line items in your DuPont analysis here for each of the years and calculated back to get to your ROE, which is exactly the same here, 35. You'll notice always you get to the same figure. And here you can notice that in 2019, AVI has a much higher return on equity than that of Tiger Brands. Okay, so much higher return on equity there. The return on assets are quite similar. Okay, AVI is slightly less. Return on capital, also AVI slightly less, but a huge big percentage difference in your return on equity balance. Okay, then it says, are there any costs that can be classified as non-recurring? Okay, so the costs that here came through are non-recurring. Okay, if I were to look at your AVI trend analysis, the profitability of AVI is looking good for the trend. Although the gross profit has declined over the last 3 years, the net profit margin has increased over the years. Gross profit declined due to potentially higher COVID-19 additional costs, and also they were impacted by the weaker rand because they import a lot of commodities. But your net profit also includes the sale of interest in your Simplots JV. Okay, so even though your gross profits come down over the years, your net profit's gone up, but we need to also factor in the fact that they've actually sold one of their JVs. Their net profit margin was also higher due to well-managed costs. So if you look at here, their net profit margin is going up over time. Okay, and they're managing their costs at least downwards. Okay, when you compare to Tiger Brands, although AVI has a higher gross profit than Tiger Brands has a higher overall net profit margin. And when analyzing the profitability measures together with the balance sheet categories, AVI is miles ahead in terms of the return on equity. AVI are clearly better operators in the space as they are able to extract additional returns for every R1 invested from an equity perspective. But to be able to make a clearer comparison, you need to be aware that AVI has a fashion business. It's got the Spitz and Green Cross, whereas Tiger Brands doesn't. So to be able to compare, we might want to actually also strip out the fashion side of the business to be able to make a like-on-like comparison. When we look at the return on equity, AVI makes use of leverage and better asset efficiency to extract higher profits. So the return on equity, when you look at it, it's coming mainly from also the use of leverage. So here, if you look at what's happening within the return on equity, here you've got your equity multiplier at 2.16. Your net profit margin is higher. When you compare to that of Tiger Brands, their asset turnovers are quite similar. Tiger Brands has a slightly higher net profit margin, but a huge percentage of the equity multiplier is coming from AVI in comparison to Tiger Brands. Okay, so they're making use of leverage and they've got a slightly better asset efficiency. Okay, AVI should look in terms of improving the ROE. They asked you how you improve your ROE. You should look at making use of better leverage, managing the selling and admin costs down over the time. AVI should also look at the procurement and analyze the list of suppliers to ensure better prices for quality of materials. AVI could also look at enhancing manufacturing efficiencies and removing bottlenecks. So those are the improvements to ROE. Important thing to notice here when you looked at part 3, what is the main contributor to the earnings? Comment on improvement in shareholder profitability. A lot of people didn't do the second part of this question. You needed to also comment to get your full marks. Okay, in terms of your recurring costs, what we needed to do is we needed to look at all the recurring costs. We got a rent concession of 14.3, so it did reduce our costs this year. We had an impairment of PPE of 18.4 and we had COVID-related costs of 58 million. If you chose to leave out the disposal, it was fine because it only asked for recurring costs. But if some people added it, I did also give a mark for your disposal of your JV. Okay, I then get to an adjusted 2020 profit. And should I then have an adjusted 2020 profit, what impact did it have on my margins? Your return on equity is still 31% in comparison to what you're sitting at here with Tiger Brands of 25, if you were to include those non-recurring costs and also include the disposal of the JV. Okay, so what I wanted you to do here is I said, what did these have? How did they impact on the 2020 profitability? Not a lot of people actually picked this up, but you're supposed to just adjust your profit level and then quickly look at what impact they had on all your profitability ratios to be able to then compute whether they are still miles ahead than Tiger Brands. Okay, the profitability decreases across all metrics given the huge disposal. So if you included the disposal, your profitability metrics actually decreased. But if you excluded the disposal, you could have also commented that your profitability increases, of course, across all metrics when you remove all these once-off costs. Okay, last two parts of the questions. Based on the ratios compiled, would you approve the investment? Yes, you should have approved the investment. The business seems to be doing well across all metrics. They're also doing a good job at managing the costs down. Your asset efficiency and your use of leverage is very good. Okay, I'll cover the last part of the solvency and liquidity question in part 2 as we are just out of time, but I'll then also compute the solvency and liquidity ratios in part 2 of the next set of questions. We'll finish off financial accounting and then move on to your management accounting section. Thank you.